Hi, Intermediate Accounting 2. In this video, we're going to go over how to account for an equity investment. An equity investment is when a company purchases stock in another company. You can have two types of investments. One investment you will do a journal entry for is a trade investment. A trade investment is 1 year or less, so they plan to sell that investment in 1 year or less. An available for sale, or what your publisher calls it, an equity investment, is a longer term investment. Okay, so let's look at the problem that we're going to go through. The equity investment without a ratably determinable fair value, can't talk. Techie Corporation purchased an equity investment in High Zoo Limited on December 15th for $100,000. So they paid $100,000 for this equity investment. Before we start the accounting, the equity investment, whether it's trade or a longer term equity investment, are still assets. So they paid $100,000. Techie accounts for the equity investment by using a market comparables. Can't talk. What does that mean? That means that they're going to adjust it to market value. Okay, so let's read on. This investment does not have a ratably determinable fair value, but fair value is estimated at $105,000 on December 31st. We'll go through the accounting. The Financial Accounting Standards Board set the standards for marketable securities. If at the end of the year, December 31st, you have not sold this investment, you have to adjust it to market value. So whatever the value is for that investment at that time. Okay, then you read on, they do not have a significant influence over the investee. Okay, so that's still going to be available for sale investment. The investment is sold on June 22nd of the next year for $114,000. What are the necessary journal entries? Okay, everybody remember that number, $114,000. That's what they sold it for. Okay, so here's the series of journal entries that you will do for this problem. The first one, you will put the investment on the company's books. So you'll go over here, we have debit and we have credit. So you will debit equity investment. Remember, that's an asset. This is at cost, so whatever it costs them, one of my debit and credits, Nader. Debit, credit, it costs them $100,000. All right, I'm gonna erase again. Here's why. I have a few entries that I need to make. So I'm gonna debit equity investment. That's at cost, and that's $100,000. Okay? And then I credit cash. That's my first journal entry that I will make. All right? What's the date of this entry? December 15th, current year. All right, that's the date. I'm trying to set it up the same as your lab. Okay. Now, this next journal entry is going to be at December 31st. This is also the current year. All right, so remember when we read in this particular problem, they said that this investment at December 31st was valued at $105,000. We have to adjust this investment to market value. Well, what's the market value? 105. Well, we already have 100,000 on the books. This investment went up. Well, went up, that's going to be an unrealized gain. If the investment went down, if they said it was valued at 90,000, that would be a loss. But this is valued at 105, great. We're going to adjust this to market value. We will adjust it up, only for the difference. So we already have 100,000 on the books. We will adjust it only for 5,000. So we go over here and we call it fair value adjustment, and it's equity investment. We're debiting this account because this is an adjunct account to the equity investment. So we're adding to it $5,000. Okay? Remember this account, fair value adjustment, equity investment. That's a separate account. It will show beneath the equity investment, but they want to isolate that. And I'll explain that why in a minute. All right, here's the second most important thing. It's called an unrealized gain. All right, let me underline that word, unrealized gain. Why is it unrealized? Because we haven't sold it yet. This is at the end of the year that we're adjusting this investment, even before we sold it. All right, so now we go to the next year. So what did they tell you? Well, on June 22nd of the following year, they sold this investment. How much did they sell it for? $114,000. Well, the 114, boom, that's going to go to my cash. So I go over here, I debit cash, 114,000. All right, now everybody watch. I am going to go back to my cost. How much did it cost me? It cost me 100. So I go over here and I'm going to credit my equity investment for $100,000. I'm running out of room. I want to show you this last entry because rightfully so, you would say, wait a minute, Professor Clay, we adjusted that investment to market value. This is a longer term. This is an available for sale or for your textbook, an equity investment. You're going to wipe out any adjustment you did. So let me show you how you're going to do that. But right now, look at this. You've got $114,000 cash for this investment. Well, the investment was only cost you $100,000. That's a good thing. Think of your own money if you invest in stock. So you're going to call this gain on sale of investment. And how much is that? That is $14,000. Okay? All right. So now what we're going to do is we're going to reverse out at the end of the year. So this is December 31st of the current year. Watch this. We're going to reverse this entry. Okay? So we're going to reverse this entry. So now we call it unrealized loss. And what we're going to basically do is just wipe this out. And this will be a debit of 5,000. I'm running out of room. And then we will credit the fair value adjustment. And this is an equity investment. Sorry, everybody, I'm running out of room. So 5,000, but let me point, we're just wiping out this entry. You're just reversing out this entry. And when you reverse out that entry, then you end up back to the 100,000. Okay, so that's how you do that particular problem. That's an longer term investment. A trade investment, you will just adjust to market value in another particular problem. All right? I will see you soon, and that's how you do that transaction.